This brief video was filmed live at a presentation recently given by Ben Habib, CEO, and Jeremy Barks, Marketing Director of First Property Group PLC. The subject of the presentation was the Polish commercial property market and its new Pan-European Opportunity Fund, Fprop Opportunities PLC, or Fprop, launched in October 2010 with an initial focus on Poland. The video is broken down into 3 sections. The first section briefly describes the background to why Fprop felt forced to move its investment activities offshore from the UK in 2005 and gives an overview of the Polish economy, Fprop's favoured investment market in Europe. The second describes 2 properties: the fund's first purchase, a Carrefour hypermarket in Łódź, Poland, and a case study of a management-intensive property recently acquired by First Property in prime Warsaw, known as Blue Tower. The third section is more general and discusses some potential questions investors may have, such as Fprop's approach to debt, its past performance, and legal tax and lease structures in Poland, Fprop's initial target market.
First Property Group, just by way of very brief background, First Property Group is an AIM-listed commercial property fund manager. So we manage other people's money on their behalf and invest it in commercial property. We do have our own cash, which we invest alongside clients, but our business model is to raise third-party money and invest it on people's behalf. I was entirely UK-centric. Until 2005. I hadn't done any international property deals at all. But by 2005, we came to the conclusion that the United Kingdom was basically too expensive, and we started selling our UK assets and looking for a jurisdiction in which to invest them. Before I tell you about Poland, which is the jurisdiction that we alighted on in 2005, I just want to tell you a little bit about our investment philosophy because it puts Poland into context. We are income-driven investors. Capital values go up and they come down, but it's income that really attracts us. Throughout the 90s and early 2000s, the simplest way to invest in property, and the way that we did it, was to buy properties that were yielding 9 through to 12, 15%, and borrow it costs around 6 through to 7%. And we would pick up the yield gap between the cost of borrowing and the yield on the property. And it was a very simple way to make money, and we made a very healthy living out of it for a number of years. But that yield gap disappeared, all but disappeared in December 2004 in the United Kingdom, and certainly by mid-2005 it had gone. And so if you were continuing to invest in the United Kingdom in those days, you would have had to have belief in capital growth and rental growth, which we didn't actually have ourselves. So we started looking for a jurisdiction where we could apply our very simple formula. Again, we looked at France, we looked at Germany. They all had very similar investment characteristics in the property market to the United Kingdom. So we went further east. We alighted on Central and Eastern Europe. We looked around Central and Eastern Europe, and if you analyse CEE, or if you did in 2005, and indeed if you do it in 2010, you very quickly come across Poland as being perhaps the most compelling investment proposition. It has the largest population, it's the largest economy, it's a balanced economy. 40% of its GDP comes from exports, the other 60% is local. So the Czech Republic, which is often bandied about, is a very good, having a very good macroeconomic picture and a progressive country, is actually 80% dependent for its GDP on exports. And so it had quite a bad credit crunch, whereas Poland, being 60% dependent on consumer spending, actually had quite a good credit crunch. Just going back to 2005, when we went to Poland, we could buy properties on 8 or 9% yields. We could borrow at 3%, which was roughly the euro borrowing rate, so the yield gap was massive. And that yield gap narrowed as the bubble took hold of the property market, but that yield gap has now again re-established itself. What Poland didn't suffer, though, was the massive setbacks at an occupational level that the United Kingdom suffer. Forgive me for comparing to the UK, but that's my home market, and it's a good yardstick for sort of Western Europe versus emerging Europe. But the United Kingdom had a lot of setbacks as far as tenant occupation is concerned from 2007 through to even now, and Poland didn't suffer those massive setbacks. Indeed, our portfolio, which has 300 tenants in it, only had one delinquency during that entire period. And I think the principal reason for it is that Poland has grown throughout the credit crunch. It's the only country in the EU not to have gone into recession. Last year it grew by 2009 was its worst year, and GDP growth was 1.8%. This year GDP growth is running at about 3.5%, and it's forecast to go up to 4% next year. Its government debt as a proportion of GDP is below 55%. Its budget deficit is higher than one might like at 7%, but still remarkably good compared to very many other countries. And so we think that Poland is set very well for the next 10 years or so. The other point I should make is that it has a tremendously advantageous demography for the next 10 years. They had a baby boom in the 1980s, so we're seeing a good throughput of 30 through to 45-year-olds at the moment, and that should continue to propel Poland forward. Poland, as you might not know, is the 6th largest economy in Europe. It is also the 18th largest economy in the world, so it's a significant economy. As I mentioned, it's the only EU country not to have gone into recession. Corporate debt in Poland is low. Corporations, I think, partly because Poland joined the international stage quite recently, and corporations weren't able to become sophisticated in the way that Western European corporations are. Corporates, entered the credit crunch with relatively low levels of debt, and that applies to the consumer as well. The consumer is relatively unleveraged. So we think Poland is set fair for the future. I think the best way to illustrate it, perhaps, is to just talk about this investment which we bought a couple of weeks ago. So this is hot off the press. As you can see from the photograph, it is a Carrefour hypermarket. I've always liked supermarkets and hypermarkets. If you buy a well-located supermarket, irrespective virtually of planning considerations, it's unlikely that if you've got the dominant supermarket location, that another supermarket operator is going to open up immediately next door to you. Carrefour is a good operator. This is a well-established location in the second largest city in Poland called Łódź, and the store trades very well as far as we can see from our due diligence. So we bought this property a couple of weeks ago. We bought it on an 8% yield. In the UK, a comparable property would cost you around 5, maybe 5.5% if you were lucky. Let to Carrefour with 11 years remaining on the lease, so good, solid, long lease, fully repairing and insuring, and guaranteed by Carrefour's parent company in France. The rent on the property is about €8.5 a square metre, which is low, again, by UK standards. A comparable property in the UK might be roughly €22 a square metre, so a big gap in rents and a big gap in yield. And when you compare the yield gap between the UK and Poland and the rental gap between UK and Poland, this becomes a much, much more compelling investment than its comparable relative in the United Kingdom. We're more likely to see rental growth out of this supermarket than you are in one in the UK. So we bought it on an 8% yield. It was sold to us by ING. ING gave us vendor financing, so we got a very high loan to value on the property. It's 90% LTV, for which I make no apology. I'm going to come back to debt in a moment, but we've got 90% LTV, 7-year term, no LTV covenant, a debt service cover ratio of 1 times. We've hedged our interest rate exposure by buying caps and fixing our interest rate for a period. And so what we've done here is take a relatively high-yielding secure investment, it's a defensively positioned investment, coupled it with a high level of leverage, protected our position on the leverage by avoiding a loan-to-value covenant and fixing hedging our interest rate, and then driven through that process a rate of return of 30% per annum on equity. I define rate of return as your rent, less your interest costs, less your management fees, divided by the equity that you've put in, less your tax, divided by the equity that you put into the deal. So your running rate of return on this investment is 30%. And we're using about 20 of that 30 to pay down the debt, so that by the end of the 7-year term, you're sitting in at around 65% loan to purchase, which is eminently refinanceable if the property value stays as it is at the moment. This is quite an unusual property in that it is quite a dry asset, but we've driven opportunity-type rates of return out of it. Another property we're buying right now is a shopping centre in southeast Poland, quite near the Ukrainian border. We're buying it on a 21% yield, which is ridiculous, but the vendor is distressed. He needs his cash. It's a 21% yield. It's well let. We know the tenants. We've got them in other shopping centres. We've talked to the tenants. They're not trading brilliantly. They're trading all right. It's probably about a 30% over-rented property. So we should be cutting rents over time. If rents don't increase, we will have to cut rents by about 30% over time. But even if we cut rents by 30%, buying in at a 21% yield still leaves you at a very high yield on the property. And that's the sort of deal that is doable in Poland. You can't do a deal like that in England. In England, an asset like that, even if you had a distressed seller, would be exposed, and the liquidity in the market would ensure that it reached a higher price. We bought 28% of this prime office building, central Warsaw. If anyone's been to Warsaw, you'll know the building. It's got a big Peugeot sign at the top, which you can't see at the moment. We bought 28% of this building in December 2008. We opened negotiations for its purchase in June 2008. We were talking about a $19 million price. We ended up buying it in December 2008 at $12.5 million. The yield on purchase was about 8.5%. And the reason that we were attracted to it was the high yield, but principally because the rents payable by tenants in the building were about 25% below market. The building is also very appealing to small and medium-sized businesses, government agencies and so on, who have a need or a desire to be in central Warsaw but can't afford prime office space. So we see it as quite a defensible asset, although a very management-intensive one. So we went in knowing that leases expired very soon, knowing that we were in the eye of a storm, but quite confident that we would be able to protect the income going forward. Since we bought it, we've extended leases, we've put rents up, and we've also taken control of the management company that is managing the property. When we bought the property, our 28% interest, we only bought a 30% interest in the management company. The management company employed 34 people. It was charging massively over market prices for the management of the property. And one of our strategic goals was to take control of that company somehow and cut costs. We were able to do that in December 2009. We now own 68% of the management company. And since December 2009, we've sacked 27 of the 34 employees. But through pushing rents up and cutting costs, we've driven income from $1.087 million when we bought the property to $1.4 million now. And that $1.4 million translates into a 44% rate of return on equity that we deployed in the property when we bought it in December 2008. And that $1.4 million, incidentally, doesn't include all the benefit of the cost savings in the management company, because some of them flow through to the management company itself, of which we now own 68%. If you add that extra income in, then we're looking at a sort of 60% rate of return on equity, on the equity that we deployed. I said I'd come back to debt. I want to talk a bit about debt. Debt was very much in fashion. It's now very much out of fashion. I've used debt all my life. I make no apology for using debt. It's a very valuable instrument as long as it's used judiciously and sensibly. And the only things you really have to remember about debt are that the income stream that's supporting it has to be capable of supporting it, so it's got to be sustainable and it's got to be sufficiently high to pay down interest and capital. And of course, the covenants associated with the debt need to be structured to ensure that you can't trip up en route to refinancing it or selling the asset. Leases typically are 5 to 10 years. Indeed, until recently, there was a legal prohibition on leases occupational leases of longer than 10 years. So the mindset is of short leases rather than the long leases that we're used to in the UK. One thing that we've done, though, in Poland is apply our UK asset management principles to Polish leases. So even though the typical office lease in Poland might be 5 years, and the typical retail lease might be 5 years, we've actually gone to our tenants and pushed out leases so that the weighted average unexpired lease term of our portfolio is now about 7 years, which in fact exceeds the Investment Property Data Bank for the United Kingdom's weighted average unexpired lease term. So we've managed to kind of apply a UK discipline to Polish assets. The areas that we do stumble on, as far as due diligence is concerned, which we find isn't the case in the UK, is that you often have a property portrayed as being absolutely clear in all respects. And then when Allen & Overy starts digging around to get to the bottom of it, you find that it hasn't got appropriate easements for its services, or it hasn't got a right of access to the main road, or the developer didn't get a proper building completion certificate when he completed the building. And so these little niggles do cause troubles to the acquisition process. But we use Allen & Overy for all our acquisitions. They're a tremendous firm, and to the extent that niggles are found, we face up to them. We either withdraw or we find a resolution to them. One has to remember this, it's a member of the EU, so it benefits from all the legal umbrella that the EU provides. It has certain transitional reliefs on taxation and so on, but they evaporate in 2013, so it becomes a fully fledged member of the EU. In any event, at this point in time, there are double taxation treaties between the United Kingdom and Poland, which allow us to remit income back from Poland without withholding taxes, without any double taxation on the income stream at the UK level. So it's quite comfortable. Some of the rates of return that I've described and you're seeing and you will see during this presentation are ridiculously high. And I almost feel apologetic about. I'm not going to apologise for the rates of return because they are what they are. But you'd be entirely forgiven for not believing them. I can assure you these rates of return are entirely capable of standing any scrutiny to which you might wish to subject them.